wealth. Investing is something I'm very passionate about because in my 24 years as an investor, I've seen too many people with too many regrets, mainly financial. My intention with this channel is to help as many people as possible with my experience to invest into assets, to build wealth and potentially retire early. So today I'm going to give you my index investing cheat sheet. I'm going to read it. It's a PDF document that I'm going to read today. You can access this in my free school community and the link can be found in my description. But first, I'm going to give you a personal story of why investing into assets is hugely important. I'm going to tell you about my dad. Now, it's painful for me watching my dad struggle in his early 60s. He's 62 and he has to work most weekends, so he's working 6 or 7 days a week because he feels he hasn't got enough saved for retirement. So this is bad enough for me to watch. What makes it worse is that he's got health issues, like the fact that he needs 2 new knees. Now, looking back on my dad's life, he could have easily saved £500 per month for the last 30 years. He's been on loads of good jobs, earned good money, but he didn't because he didn't have any financial education. Now, let's assume my dad did have some financial education 30 years ago, so in his early 30s. Let's assume he invested into something like the S&P 500, getting average returns of 10%, and this is based on historical data, over 100 years of historical data. If he'd have done this, if he'd have invested £500 every month for 30 years, he would have ended up with over £1 million. And when you look at it, most of that money is from interest earned, the power of compound interest. So, a bit of homework for you. If you learn about things like compound interest and the harmful effects of inflation, I'm very confident you will invest into assets. Let me know in the comments, are you an investor or a saver? Or worse, do you keep your money in cash? Let me know. So, the Beginner's Guide to Index Investing, a step-by-step cheat sheet. And if you want access, if you want a PDF document, something to refer back to, type yes below in the comments. What is index investing? Index investing is a passive investment strategy where you invest in funds that track a stock market index, like the S&P 500 over in the US, or the FTSE 100 here in the UK, or MSCI World Global Markets. Instead of picking individual stocks, your money is spread across hundreds or even thousands of companies all at once. Key benefits of index investing: diversification. It reduces risk by spreading investments across multiple companies. Low costs, much cheaper than actively managed funds. Simplicity, no need for stock picking or constant monitoring. Historical consistency. Stock market indices have averaged 8 to 10% annual returns over the long term. And again, that's over 100 years of historical data. Passive investing, set it and forget. Your money works for you. Because it's set and forget, it's stress-free. And this is why index investing is my favorite way to invest. How to get started with index investing. 1, understand your relationship with money. Before you even start investing, check your emotions about money. Many people fear losing money. They chase get-rich-quick schemes or make emotional decisions. This was me up to the age of 35 before I found financial education. And getting too emotional, chasing quick, easy money won't do you any favours, trust me. This can lead to panic selling during market drops, buying high and selling low due to fear or greed, trying to time the market, which often results in losses. As the saying goes, it's not about timing the market, it's time in the market. Solution: recognize your emotions about money and develop a neutral mindset. Treat investing as a long-term journey, not a quick win. Follow proven strategies of successful investors. Think about Warren Buffett, John Bogle, people like that. 2, learn about compound interest, your wealth multiplier. Compound interest is hugely important. Compound interest equals interest on top of interest. This means the longer you invest, the more your money grows exponentially. Example of compound interest: investing £100 per month at 10% returns grows to £632,407 in 40 years. Investing £500 a month at 10% returns grows to £3.1 million in 40 years. Investing £1,000 every single month at 10% returns for 30 years results in £2.26 million. Key lesson: start as early as possible to maximise the benefit of compound interest. Even small monthly investments grow massively over decades. 3. Build a cash buffer before investing. Before investing in the stock market, you should first secure an emergency fund. This prevents you from having to sell your investments in a financial emergency. Recommended cash buffer: 3 to 6 months of living expenses in a high interest savings account. Avoid investing money you need in the next 5 years. This 3 to 6 months cash buffer is what the experts recommend when you read the books. Why is this important? If you lose your job or have unexpected expenses, you won't need to sell your investments at a bad time. A cash buffer equals financial security and allows you to invest stress-free. 4. Decide how much you can invest. Ask yourself, how much can I invest each month? How long am I willing to keep my money invested? Am I comfortable with market ups and downs? Suggested investing strategy: start with whatever you can afford, even £50 or £100 per month. Increase your investments as your income grows. The key is consistency. Investing monthly is better than making one big investment. This is called DCA, dollar cost averaging, or pound cost averaging here in the UK. 5. Choose a low-cost investment platform, brokerage account. You need a brokerage account to invest in index funds. Popular investment platforms: UK, Vanguard, Hargreaves and Lansdown, AJ Bell, Interactive Investor. In the USA, Fidelity, Vanguard, Charles Schwab, M1 Finance, Europe, DeGiro, eToro, Trading 212. Things to consider when choosing a platform: low fees. Avoid platforms that charge high management fees. User-friendly interface. Easy to buy and track your investments. Good customer service and reputation. Now, before I go any further, before I start talking about picking your index fund, I just want to touch on how I can help you. Well, you can join my free investing community on School. All you've got to do is type yes below in the comments. I'll send you the link. You can join the community and get around hundreds of other investors. You get one-to-one support from me, and you can also get this cheat sheet that I'm talking about today as a PDF document, so you can invest in the stock market step by step. And this PDF document is something for you to refer back to. Anyway, moving on. 6. Pick your index fund, the key to success. What is an index fund? An index fund tracks a stock market index like the SP 500, FTSE 100 or MSCI World. It gives you exposure to multiple stocks in one investment, unlike individual stocks. Individual stocks, yes, you can make money, but it's much higher risk, as I found in 2011 when I lost our life savings gambling in the stock market without doing any research. Please don't do this. If you want to invest in if I get my words out, in individual stocks, research. Make sure you fully understand what you do, what you're investing into. Make sure you fully understand the company you invest into. Anyway, recommended index funds: the FTSE Global All Cap Index Fund, 7,000 plus stocks worldwide. S&P 500 Index Fund, the top 500 US companies. This is simple and probably gets you the higher returns and is what many investors choose to go with, the S&P 500. Vanguard Life Strategy 80/20 or 100% equity. Now, the Life Strategy 100 fund is a fund I like. It's got 7,000 companies in it, over 7,000 companies, and it's the fund I've invested in since 2019 for me and my 2 daughters. Choosing risk level. This is important. Low risk, Life Strategy 20, so that would be 20% stocks, 80% bonds. Medium risk, Life Strategy 60, 60% stocks, 40% bonds. High risk, Life Strategy 80 or 100, 80 to 100% stocks. The best option for long-term growth is more stocks and fewer bonds. Now, if you've got time on your hands, if you're going to invest for 20, 25 years, I would probably go with 100% stocks, because you have time on your hands and you can ride the inevitable ups and downs of the market, because the market isn't going to go up like that. It's going to go up and down. Sometimes your fund might be down -2%. Sometimes it might be up 10% or even 15%. 7. Automate and invest consistently. Set and forget. Automate your investments. Set up a direct debit each month so you don't forget to invest. This follows a strategy called dollar cost averaging, DCA. Dogs are going mental outside. DCA is where you invest at regular intervals to smooth out market ups and downs. Ignore the noise. This is a big one. Markets go up and down, Don't panic when prices fall, which is what most people do. Stay invested for 10, 20, even 30 years and let compound interest work. Fuck me. Apologies. Someone's trying to ring me and then messaging me. So I'm going to carry on. I'm going to give you another example of compound interest. So, unfortunately, I didn't get any financial literacy at school, but I know for a fact if I'd have been taught about money at school, I would have invested from the age of 18 to now, so a full 24 years. In fact, I did start investing as an 18-year-old. I invested £500 a month in a stocks and shares ISA and done this for 6 months, but unfortunately spent all my savings on a lad's holiday. Yes, the lad's holiday was brilliant. We had a good time, but it was a huge mistake because if I'd have kept on investing £500 every month for 24 years, I would have ended up with 592,000. This would have meant financial freedom in my early 40s. And when you look at that huge amount, £450,000 of that money is compound interest. Again, demonstrating the importance, the power of compound interest. Hopefully, you're taking on board the power of compound interest. 8, avoid common investor mistakes. This is a big one. Mistakes to avoid. Waiting too long to start. Time is your best friend in investing. Trying to time the market. Please don't do it. Invest consistently instead. Dollar cost average every single month or every week. Not diversifying. Stick with broad index funds. Again, the simple way to build wealth. Panic selling during market drops. Markets recover over time. Ignoring fees. High fees reduce your long-term profits. So when you're looking at a platform or a fund to invest into, have a good look at the fees. It's important. Golden rule. Stay invested, be patient, and let compound interest do its job. How to become a millionaire with index investing. The key to becoming a millionaire is time and consistency. Example, a 10% annual return, monthly investment years to reach £1 million. £500 per month, you're talking 29 years. £1,000 per month, 23 years. £1,500, 19 years. Yes, 500, 1,000, £1,500, huge sums of money. Just to show you what's possible if you can invest this type of money every month, if you've got the discipline to invest long term. Basically, the sooner you start, the faster you reach financial freedom, and then you can live life on your own terms. Next steps, action to take today. Books to read. These are some of the best books I've read over the last 6 years, and I've read hundreds of books on mindset, finance, investing, money in general. So here's 3 recommended books from me. The Little Book of Common Sense Investing by John Bogle, Unshakable, Tony Robbins, The Intelligent Investor, Benjamin Graham. Action plan. Open a brokerage account, pick an index fund, set up monthly investing, and stay invested for the long term. Index investing is the easiest, lowest risk way to build wealth. Stay consistent, ignore the noise, and let compound interest do the work. Again, if you want my index investing cheat sheet, type yes below in the comments and you can join my free investing community on School, again, where you get around hundreds of other like-minded investors, because I believe we all need help and support in anything we do in life, and that includes investing. You can also have a one-on-one call with me in that free group. Again, type yes below or have a look at the link in the description on this channel. Hopefully you've taken value from this little video, this little live stream. Obviously nothing I've said should be taken as financial advice. I'm not a financial advisor, as you can probably tell. I'm just literally trying to help as many people as possible with my experience, because I know that investing into assets is hugely important. The financial system is broken. Inflation is bad, really bad. And if you don't invest into assets, you're going to struggle financially. If not now, then later. As I said at the start, I've seen too many people with too many regrets, mainly financial, mainly people in and around the age of retirement. And I'm sick of seeing it. That's why I've got this channel. That's why I'm trying to help people with my investing experience. If you've got any questions, ask in the comments. Anything related to personal finance, money, investing, and if I can help you, I will. That'll do for now.